That's all it is. It's artificial. It creates artificial demand for the dollar. Because at this point, I mean, who are buying treasuries? Japan's not buying treasuries. They're selling. China's not buying treasuries. They've been selling for a few years now. The demand for treasuries is no longer there, which leaves the Federal Reserve now not even a separate entity. Now it's underneath the Treasury umbrella. The Treasury, so it's the left pocket lending to the right pocket. That's the demand. So they had to do something, and that's what the stable coins are. Yeah, we've been in a supply deficit for, 5 years now. That started to come to a head whenever available supplies had been used up. And as people understood this was happening, demand increased. If you go back, 3 years ago, when the Russian treasuries, the 300 billion, were basically sequestered, that's what kicked off the move away from dollars and central banks wanting to buy gold to basically hedge. They're thinking if Russia can have their reserves stolen, so can we. So if you look at a chart, the following day, gold started to look like a tractor in first gear. Now, silver is not just a monetary metal. I mean, there's industrial uses, medicinal uses, technological uses. All that demand overwhelmed the above ground supply. And as you mentioned, what the mines are producing is roughly, call it 850, 900 million ounces. And it looks like this year, we're probably going to end up with a demand of 1.3 billion ounces. So there's your shortage. And when you tell a human being that they can't have something, they want it even more. And what you're looking at now is the paper markets are beginning to break. And we're moving toward more of a, like you said with that commercial, I want my money and I want it now. We're moving toward a cash and carry market. The Asians do not trust contracts. The Asians want to buy something and have it delivered. And there's your problem. That's the only way to adjust the supply and demand, the only way to ration demand and increase supply, but slowly, because mines can't increase supply quickly. The only way to do that is to increase the price, and that's what you're watching.
Silver's imbalance is stark. Global mining supplies roughly 900 million ounces annually, yet demand now approaches 1.3 billion. That gap cannot be closed quickly because new mines require years, not months. As shortages emerge, paper trading mechanisms strain under delivery demands. In Asia especially, buyers distrust abstract contracts and insist on physical settlement. This preference exposes weaknesses in leveraged markets built on assumptions of availability. The system slowly migrates toward cash and carry pricing, where immediate delivery sets value. Rising prices become the only tool left to ration demand and signal scarcity across interconnected global commodity exchanges today worldwide.
Yeah, no, that's a very real possibility that you see some nationalizations. I believe that equities in North America are probably most at risk because, I mean, look at the finances of the US, look at the finances of Canada. It would just make sense that they try to, they try to confiscate gold in the ground. If you go back to the year 1900, mining companies resembled what utility companies are today because they were mining money, and they would pay out a good dividend. They were very stable, solid. They were widow and orphan type stocks. As far as going forward, that it's going to be much different because we're not going to be in the world of 1900 going forward, because as far as mining concerns are concerned, miners are going to be they dig money out of the ground, and if that's happening in a backdrop where fiat currencies are failing, and we get to the point where gold and silver become very scarce for investors to purchase, what's your alternative? You're going to have to purchase mining companies if you want exposure to metal that you can't buy. And that's assuming that markets stay open. And I don't assume that, but it's assuming markets stay open. Just understand that if you're buying a miner, and there's all types of miners. I mean, there's explorers, there's juniors, there's majors, from the bottom of the chain all the way up. The more senior you get, the less risk there is, but you also have to look at the geographical area that your mine is at. I mean, is it at risk of confiscation? What I'm trying to say is there's much more risk in miners than there is in the metal itself, but it may become the only choice if you can't buy gold or silver, if it doesn't exist to buy. I don't think there'll be a confiscation because well, first off, people are worried about the government going door to door. That'll never happen because there would be 100 deaths on the first day. I mean, people come to the front door and say, give us your gold and silver, and we're going to get lead instead. What I think is much, much more likely is that they change the tax laws and they say, okay, whatever your cost basis is, you got to pay, pick a number, 90% tax on your gain. I think that's much more likely than confiscation.
Okay, got it. So
and that will create black markets, by the way.
Yeah.
When you create a black market and you tell a man he can't have something, he wants it even more. If you look at that chart, it's ugly. Equities have rolled over to the downside versus gold. And I would say, you're asking me how much time? I would say just look at the charts. The charts are telling you there's very little time left. And my answer would be we're just one crisis away from someone defaulting and breaking the daisy chain.
Beyond markets, politics loom. Resource nationalism becomes tempting when governments face fiscal strain. Mining assets, especially in North America, may draw scrutiny as strategic wealth embedded underground. Historically, miners resembled utilities, producing money and paying steady dividends. That era has passed. In a world of weakening fiat currencies, extracting precious metals becomes politically sensitive. Investors may face a dilemma. Physical metals grow scarce, while mining shares carry operational and geopolitical risk. Senior producers offer relative stability, juniors higher reward and danger. Geography matters, as jurisdictions differ sharply in their appetite for control during periods of monetary transition and stress globally.
Yeah, it's definitely underreported. I mean, I could show you on the back of a napkin how China, unofficially but official reserves are at least 35,000 tons. And they say they've got, 3,000 tons. I mean, they've done it. If you look at what's gone through Shanghai over the last 15 years, plus their production of 400 tons per year, they're so far above 3,000 tons of reserves, it's not even funny. I would just say that the East, Asia, China, India, they know the game is up. If we understand that there's, a fiscal mathematics problem in the Western world, they got smarter people than we are. They know. And just look at the BRICS. How many countries have joined the BRICS? 140, 150 countries? That's more than half the world. Well, I mean, way more than half the world geographically. They are moving away from the dollar because they understand that the dollar is going to basically default. And when I say default, there's two types of default. There's non-payment, which that'll never happen. But then there's overissuance, and that is happening.
Mm-hmm.
Overissuance is inflation. Hyperinflation.
Yeah, for sure. I mean, they'll pay you back in nominal terms, and the dollar's
monkey
decrease.
Money. They'll pay you back in monkey money.
Yeah.
Monopoly money, whatever.
Yeah, for sure.
Yeah, I haven't followed that real closely, so I don't know how far along that is. But that's simply Italy taking an Eastern mindset and saying, "Hey, it's our gold. We want control of it. We want it within our borders."
Hmm. Yeah, for
And
sure.
you could go back, Daryl. You could go back to what was it, 2013, when Germany said they wanted 300 of their tons back that was being held in New York, and they were told, "Oh no, this is going to take like 3 years." And I did the research, I wrote an article that 300 tons could have been transported on four 747 cargo planes. Those can hold 95 tons per plane. So they could have done it in what, 2 weeks, three planes, and then not a fully loaded third plane. Now, by 2016, 3 years later, Germany got their gold, but guess what? It was not their gold. What they deposited was returned to them with different registration numbers. It was not the same gold. But the United States had 3 years to source 300 tons.
Confiscation fears often dominate headlines, yet subtler tools are more likely. Direct seizures provoke resistance and chaos, making them impractical. Tax policy, however, can achieve similar outcomes quietly. By sharply raising capital gains taxes on precious metals, governments can discourage ownership without force. History shows such constraints breed black markets, where scarcity fuels desire rather than suppressing it. Chart comparisons already show equities lagging hard assets, signaling a narrowing window for adjustment. One systemic failure or major default could fracture confidence, breaking chains of obligation that hold paper systems together during accelerating inflation and eroding institutional credibility worldwide today now.
Yeah, I'm not real big on platinum, palladium, just because they're not truly a precious metal. I mean, they are industrial metals. The gold to silver ratio got as high as 120. Now it's what, 63, 64, something like that. Silver comes out of the ground at 9 or 10 to 1 versus gold. And for hundreds of years, it was discounted to 16 to 1. The reason it was discounted 16 to 1 from 10 to 1 is that it took 10 times the amount of weight when you're moving either gold or silver. It took 10 times more silver versus gold to move the same amount of capital. So because it was more difficult to move silver, man discounted it to 16 to 1. Then along came COMEX in 1976. The suppression scheme started, and silver's much easier to suppress. It's been suppressed for that 50-year time frame. And now that looks like it's beginning to unwind. I mean, I would not, if you've got silver and you're wanting to convert it to gold, I'd do it in tranches. I'd do it in 4 tranches. I'd probably do a quarter when we got the 50 to 1, a quarter at 40 to 1, a quarter at 30 to 1, and then the last tranche of what you want your final mix to look like. You do that final tranche based on your gut. Yeah, gold is the money of kings, the money of governments, if you will, and silver is the money of the people. And I do think that, especially China, but the East views silver more from a monetary mindset than Westerners do. So I think silver, and I'm not saying that silver and gold are going to become currency. They're not going to. You're not going to ever see convertible paper monies that are convertible to gold and silver, because they've already figured out when they do that, it converts, and then their supplies are wiped out. But I do believe that you're going to see governments back currencies with gold and silver, but not be convertible. Will be ratio back, 20%, 40%. I mean, I don't know what the number is going to be, but I do believe for a currency to be trusted, it has to have some sort of backing. And that's what the BRICS are doing. That's what the BRICS have been talking about, going on what, 6, 7 years now. I think that's where we're headed, is toward a ratio-backed currency and that backing will be gold and silver. That's all it is. It's artificial. It creates artificial demand for the dollar. Because at this point, I mean, who are buying treasuries? Japan's not buying treasuries. They're selling. China's not buying treasuries. They've been selling for a few years now. The demand for treasuries is no longer there, which leaves the Federal Reserve now not even a separate entity. Now it's underneath the Treasury umbrella. The Treasury, so it's the left pocket lending to the right pocket. That's the demand. So they had to do something, and that's what the stable coins are.
Meanwhile, power quietly shifts east. Asian nations accumulate gold through trade flows and domestic production, often understating official reserves. China, India, and a growing BRICS bloc increasingly view metals as strategic anchors rather than speculative assets. This movement reflects skepticism toward dollar dominance, not sudden hostility. Overissuance, not non-payment, defines modern default, expressed through persistent inflation. As trust erodes, nations repatriate gold, preferring custody within their borders. Past delays in returning reserves raised uncomfortable questions about true ownership. The message is clear: control, not yield, now drives reserve strategy across emerging and developed economies facing debt saturation pressures today globally.
Whatever it takes. They will print whatever it takes. And I mean, 2008, 2009 should show you that.
Yeah.
You know, the Federal Reserve lent, what was the number? $17 trillion, more than half of that outside of the U.S. to support the system. And we didn't find out about that until 2010. I think they had to. I mean, if gold went from, 1,300 to 2,000 and then chopped around and went from 2,000 to 2,500 and then exploded not exploded, but like I said, the day after the Russian treasuries were confiscated, gold started going higher. The banks can't tell you don't believe your own eyes. So the market pretty much forced them to lend some credence, otherwise they become irrelevant. And I mean, the public, think about this, for going on, it's 10 years now, 2015 and on, we've been fed nothing but bullshit in every way, shape, and form. All the government reports, oh yeah, we're running at 3% inflation. Really? What is that? 3% a month or 3% every quarter? We know that's wrong. Unemployment numbers. Really, only 4% of the population's unemployed, and you got 100 million people not working. The COVID jabs. Maybe you should talk about this if you put it on YouTube, but the COVID jabs, safe and effective, turned out to be what the alt media talked about, with the spike proteins, etc. No matter what the topic is, we've been fed bullshit. And people are waking up, and I think the banks understand that they can't tell a public that's watched gold run from $3,000 to $4,400 in 6 or 8 months. They can't tell them that gold bad, hold your savings in dollars. They can't say that. So I think they were forced into it. Yeah, on my website I have an icon up top. It's called Grizzly's Corner. This is a guy that can go into central Idaho with a pack of mules for 6 months at a time and come out fine. He's written a bunch of articles. He's put a bunch of links up of products that he's used. That's a good resource for prepping. When people ask me, how much should I put into gold and silver? My standard answer is whatever you don't want to lose.
Yeah. That's that could seem like a lot at times. So
and lead is another precious metal.
Yeah, for sure. Yeah, it sure is. I've definitely been buying more of that, especially since the pandemic and the shortages we saw there. So yeah,
and it will barter. I mean, if you have, maybe not odd calibers, but if you have common calibers, that's going to be good barter.
Gold and silver occupy distinct cultural roles. Gold serves states and institutions. Silver speaks to households and daily exchange. Ratios between them reveal stress within monetary systems. Historically aligned by scarcity and transport realities, silver was later suppressed by paper markets. That suppression now shows signs of reversal. While full convertibility is unlikely, future currencies may regain credibility through partial metal backing. Such structures manufacture trust rather than abundance. As financial narratives lose authority, tangible assets regain relevance. In uncertain times, preparation favors what cannot be printed, promised away, or quietly diluted by policy shifts, leverage, and systemic opacity worldwide.